we're buying an old Kmart or grocery store for a couple million. We'll put a couple million into it. We are the GCs. We do the construction in-house. It costs plus 12%. So we're be into a project for a couple million, put a couple million into it. And as we've gotten better with our strategy, our average project at stabilization when it's full is appraising for 13 to 17 million.
All right. What's up, everybody? We're back for another episode. I'm excited today about our guest. He's got a lot of great experience. Turns out he and I have a lot in common. Places we lived, and actually we went to the same school, and I know a lot of the same people. And when I found what he was doing, I was like, man, I got to get to know this guy. I don't know how I don't know him better. But Clint, welcome to the show.
Yeah, thank you, man. I'm happy to be here. Same thing. I was in a social club with a bunch of your roommates. I've been in your house before. Yeah, I don't know if you were there or not at the time, but yeah, small world. It's great to be able to connect.
Yeah. So Clint and I were talking about this before the podcast, before we started recording. But in college, I had this house right across from campus, and this guy that owned this house, it was like a 1,200 square foot house, but he had split this house into 4 different units, and each unit had at least two guys in it. But this house, like, the doors were always unlocked, and it turned into like the hangout for the school off campus. And so I would come home and there would be complete strangers in my house, like, just hanging out. And it was fine. Like, I didn't own anything that someone could steal, and it really, what did I have that was really worth anything? But it was just so funny because every day I would come home and, like, I don't know half these people, but it was great. It was fun. So I'm not surprised to hear that you were actually in that house.
Yeah, I was those people.
That's awesome. Well, tell us a little bit about you. Like, give us a little bit of your story and stuff, where you grew up, where you went to school, and how you got into real estate.
Sure. So my name's Clint Harris. I'm from South Carolina. I went to college at Harding University in Arkansas. And coming out of college, I was pre-med major, always interested in medicine, but also very interested in business. So I started off as pre-med, and I decided I wanted to go into medical sales because it was business and medicine. So graduated from Harding University, met my wife there. We were just best friends for years, dated years later. So my wife also went to Harding University. And fast forward, I got out of college. I did a year of medical training, and I had a 16-year career implanting pacemakers and defibrillators. So I moved back to South Carolina. Ironically, the best job offer I had was close to where I grew up. And so, yeah, spent 16 years in surgery, was a clinical rep, and then a trainer and a sales rep. And then eventually in 2017, I took a promotion to move to Wilmington, North Carolina, to take over a territory there. So was running a territory at the beach, which is, Wilmington, North Carolina, coastal town, a lot of beaches close by. So I spent 16 years just kind of living that lifestyle. And the reality is medical sales, specifically surgical sales, is kind of a young man's game. You're on call, working nights and weekends. Heart surgery, unfortunately, is not 9 to 5, Monday through Friday. So a lot of windshield time, a lot of late nights, and getting called, up to 1 to 2 hours in different directions for emergencies. So I always knew that was a young man's game. And even though I loved it and I was good at it, I wanted the decision of when I decided not to do it to be up to me. And so we started looking for a way to build an off-ramp from a very busy and demanding lifestyle. It's kind of the scenario is like, look, you don't wait till it starts raining to start building Noah's Ark, right? You gotta plan ahead for that. So we started off investing in real estate. My first property when I was in my early 20s was a duplex. So before I knew the term house hacking, I thought I invented it, thought I was a genius. But I bought a duplex in Columbia, South Carolina, lived in one half, rented the other half to a friend of mine, and broke even, and I was ecstatic. Mm-hmm. Then my girlfriend at the time, later fiance and wife, I talked her into buying a foreclosure property in the same neighborhood and had 2 master suites. She brought on a couple roommates, same thing. She was house hacking. Later, we got married. I moved into her house. Roommates left. I moved into her house, kept ours as a rental, and we were investing in single-family homes. So we had 9 single-family properties. We BRRRR'd a couple of them. Didn't really know what I was doing at the time, but we would recapitalize through a refinance event. And what I learned is that property managers are really horrible. Even if you find one that's good, a lot of times they're not good for very long. And if you have a single family home one property. I wasn't doing Section 8, but it wasn't much better. It's a very slow way to scale, and it wasn't going to get us to a point of having a meaningful effect on financial freedom. So when we moved to the beach, we moved to an area that gave us the opportunity to look at short-term rentals. So broke out the iPad. I was running all kinds of analysis, and ultimately what we decided to do is, in the island where we live, it's called Carolina Beach, we were buying small multifamily properties, duplexes, triplexes, quadplexes, with bad long-term tenants in place that hadn't had a rent increase in years. And we were moving those month-to-month tenants out and converting them to Airbnb properties. So we got heavy on the operation. We still have 14 Airbnb units at the beach. So that's done really, really well. And we reached a point of financial independence. Like it replaced my income. I was still working. We were doing it all on the side. It replaced my income, but we got that wrong. Like what we were after was financial independence, which is what most people are pursuing, right? It's a buzzword. Everybody talks about financial independence. What it didn't give me was location or time independence, especially during the summertime at the beach. You're locked into a location. I've still got my phone on me, so I'm the equivalent of being on call even when I was not on call, dealing with the operations, right? Instead of 1 tenant per month, I got 8 to 10 tenants per month in each unit, right? So it's a lot. So when I figured out that we had achieved financial independence at the cost of time and location independence, I couldn't find a property management company that could run and get the kind of numbers that we were getting. Like they were looking at our numbers and they were like, there's no way, you're not doing this. But as an individual operator and doing it really well, like we did great. So that turned into building a property management company. So my wife and I, we have partners. We've got a property management company that manages our listings and another 85, which is great because it manages my listings at cost. I've got an operating partner who does a fantastic job, a couple managers, 6 cleaning teams, 16 to 20 cleaners. And it's good. So for me, it looks like a passive investment, right? Owning the company and owning my properties looks very passive. The reality is you're an operator. You know how this is. Like the property is only as good as the person operating it. The reality is it's not passive at all. It's residual. Now, I had to front load several years of work to get it where it needed to be. So from outside looking in, it's easy to look at me and be like, that's a passive investment. The reality is it's absolutely not. I just front loaded the work on that and it's residual now.
Yeah.
So I had a mindset shift because of that. And I started the aggressive pursuit of the most passive investment strategies that I could find that were going to give the best returns. Because what I came to learn is that we're not after financial independence. That's actually pretty shallow on a base level. What we're after is financial time and location independence. And if you achieve those 3 things together, it creates an independence of purpose. Independence of purpose is where you go, where you want, when you want. You spend your life how you want to, hopefully doing something meaningful for the people you love and the community that you live in, right? But whatever that may be, it's up to you. And that's going to look different for every person. So I started the aggressive pursuit of passive investment strategies, which led me to self-storage. You're basically renting someone a box of air. It's very low maintenance type of investment. And then that led me to syndication and the idea of pooling capital together from groups of investors to take on projects larger than what any individual could likely handle on their own. So I've always been going to the BiggerPockets meetups and the local real estate meetups and meeting people because I believe that life is about relationships. And that's where I met my partners. It's a father and son team of a couple guys named Eric and Levi Hemingway that had dabbled in self-storage in the past. And in 2021, we bought a Kmart building. I was still selling pacemakers and defibrillators. So in 2021, I grabbed a couple of the cardiologists and doctors that I worked with. I put money in, they pulled money in, Eric and Levi pulled money in. We bought an 87,000 square foot Kmart for $1.5 million. Nobody wants a Kmart. They're huge. They have great residential density in a 1,357 mile radius. That community used to drive to that building to buy their stuff. Now they all get it through Amazon or Walmart. But the location is still great for those same people to drive back to the same building and pay us to put the same stuff right back inside of it. So it's just an inverse flow of the localized economy. So we bought a Kmart for 1.5. The replacement cost just on the brick and mortar shell was 6.5. So we bought it for pennies on the dollar from the replacement cost. put $2.5 million into it. So we're into the project for $4 million and it appraised for $9 million. So it's like, oh, okay, this is real money. And in retrospect, it wasn't the best deal that we've done, but it proved a concept. We did that as a joint venture and absolutely proved the concept. So from there, we tightened up, we got better. I started raising capital for future deals. And then in 2022, I left medical sales behind for good. My company actually lost my job. My company had a reduction in force across the country and laid off a couple different waves of people, indiscriminate of goals and everything else. They were just looking for people that had the shortest amount of time left on their contract so that they could get away with paying the least amount of severance. So it doesn't matter your performance or anything else. If someone is dictating your paycheck, that can go away, right? And you're at the base level, you're trading time for money and paying for somebody else's days off. So I lost that job, which is a huge blessing because I was actually looking for how am I going to transition out of this over the next 1 to 2 years and keep my relationships with all my physicians and friends that I work with. So in retrospect, huge blessing. 23 weeks pregnant with our second child, brand new house that we had just finished construction on and closed on in a couple weeks, lose my job. In retrospect, the short-term rentals that we have certainly helped. The property management company that we built has certainly helped, but the economics from those first deals in storage are what changed the financial trajectory of the rest of our lives. So after that first Kmart, the next 2 years after that, we bought 2 Kmarts, 3 warehouses, a grocery store, a Sundrop bottling facility, and 2 textile mills that we have converted to climate-controlled self-storage in secondary and tertiary markets across the Southeast. It went from a couple of dudes around a card table figuring it out to an office now. We've got 4 general partners. I'm one of the general partners. We've got 16 employees. We're currently at 600,000 square feet net rentable and 5,000 storage units online right now. And we're sitting on $150 million worth of assets under management. So that's been the 3-year ride. We've got a 5-year goal of $500 million and a 10-year goal of $1 billion. And the reason that it works and the thing I get excited about is because we're buying an old Kmart or grocery store for a couple million. We'll put a couple million into it. We are the GCs. We do the construction in-house at cost plus 12%. So we're be into a project for a couple million, put a couple million into it. And as we've gotten better with our strategy, our average project at stabilization when it's full is appraising for 13 to 17 million, which means we don't have to liquidate the assets for everybody to get a payday. So we'll refinance. We're sitting at 35% LTV at stabilization. For the cost of the building plus the construction, we're average $65 a square foot across all the projects we've done. So Josiah, if you and I decide to go build a self-storage from the ground up, it's going to cost us $120 a square foot plus the cost of the land because nobody wants these old big box retail buildings. We pick them up for pennies on the dollar. Usually we're buying the building $20 to $25 a square foot, putting about $40 a square foot into it. So we're sitting at $65 per square, which is 35% loan to value, which means at stabilization, we can refinance the property to like 55, maybe 60%. We don't want to stress the asset. It's a golden goose, right? You don't want to kill and eat the golden goose by selling it. You'd rather keep it and keep living off the egg. So we'll refi to 55, 60%. It's enough capital for us to double our investors' return. When you pay people out by way of refinance, that's not a capital event because we didn't sell anything, so it's non-taxable. And then all of our investors stay in. Everybody keeps their same percentage of equity. We hold the properties long-term. We've recapitalized. We've paid out the investors, pulled a couple million out for Nomad, tax-free, and then we can keep the asset, move on to the next one. And yeah, we're on the pathway to $1 billion with a goal of trying to create a tribe of real estate nomads, people that can go where they want, when they want, do what they want because they've achieved that independence of purpose. So it's the economies of scale that come along with a big goal.
That's amazing. So, okay, so you did all the commercial stuff you've done in 3 years?
Yes.
Is that what you said? That's insane.
caveat there. My partner he's got 30 years of commercial construction experience. He built his first self-storage for himself in 2006.
Okay.
So this is cool. Like, my partner, Eric, built his first self-storage in 2006 for himself, bootstrapped it. The market crashed in 2008. Eric and his wife, Rachel, and their 5 kids bought a catamaran sailboat, 36-foot catamaran in Greece, sight unseen, flew to Greece with their 5 kids, found out 6 months into sailing around the Mediterranean, found out they're pregnant. They stopped and had their 6th kid in Israel, had to make sure he did not get Israeli citizenship because it comes with 2 years of military service. And then they kept sailing. So Eric, his wife, and their 6 kids spent a total of 3.5 years sailing around the Mediterranean because they had commercial assets that were paying for that lifestyle.
Yeah.
Then they sailed across the Mediterranean. Then they sailed across the Atlantic and landed back in Wilmington, North Carolina, which is where we are. Then they started building houses, flipping, and doing other things, but always had a love of self-storage. So got back into storage, did a conversion project in 2016, another one in 17, and another one in 19. Those are the guys doing the heavy lifting, right? I have a capital raising, I've got a network because of the physicians that I work with. I had a 16-year sales career, so it makes it easy for me to communicate what we're doing. So I tend to try to be a little bit more forward-facing. I'm going to the conferences, having the investor calls. I'm doing the podcasts and that nationwide marketing that we're just launching, and they're the ones doing the real work, right? Like I've become a huge fan of the construction, the complicated issues they have to navigate. They're the guys doing the work, right? I'm bringing the money for any project, and especially anybody that doesn't know how to get into real estate and is kind of looking for that journey. You have to have 3 things. It's time, it's experience, and money, right? So I'm going to get the money part of it from our investors. Typically, our average investor is a lot of white coat professionals or IT professionals or small business owners that sold and had a capital event that they're looking for a place to put their capital, right? So we're still combining those 3 things. It's their money with our time and our experience so that the whole is greater than the sum of its parts.
Yeah. Yeah, I love that. Yeah, I mean, strategic partnerships will do everything for you in this business. And like, I wouldn't be anywhere close to where I am in my real estate journey without my partner on the whole thing, because he's got strengths that I don't have, and we complement each other well. Sounds like you've gotten the same thing going with these guys you're working with. But I want to talk about a piece of this journey I think that everyone can relate to, which is you're in the job doing the medical device sales, and you're also working on the real estate thing at the same time, right? And based on what I know about that job, you're on call for surgeries. So how are you balancing all that, trying to get the real estate thing going and being called away to these surgeries, and just like, how are you pulling all that off?
Poorly. So
not easy, right?
I would say this. So my wife and I both had a background in medical. She was in durable medical equipment, CPAPs, oxygen concentrators, that kind of stuff. We always knew we had a passion for real estate. So when we moved to Wilmington, and we started having success with our Airbnb properties, she left and became a real estate agent for us, but also because we used that as a springboard for her to start having a career and having a lot of success with real estate sales at the beach, which obviously has a pretty high price point. So that freed her up a lot to handle a lot of this. As we got more into the commercial side of things, I was literally like at the hospital doing a procedure, running in my scrubs, 10 minutes away to our office, where it's a tiny office in a self-storage facility, and we're literally just crowded around a card table figuring it out. And then I'd run back to the hospital. So there was a lot of hopping back and forth, and I would have continued to do that, not to the best of my ability, but to the best based upon the amount of time that I had, for another year or 2. And then that decision got made for me. But the reality is, like, some of the things that make it easy is I have a passion for it. I've got an entrepreneurial spirit and I love it. And number 2, I'm married really well. And I think continuity of goals with your spouse is wildly important, right? Because, if you're in the same boat, you need to be rowing in the same direction. So, support of a loving wife as to what I was pursuing, because we have goals for our lives bigger than what anyone can offer us by us trading time for money. And then just juggling and doing the best I can. Honestly, with COVID, so many people were forced to start using Zoom that it became pretty easy for me to start doing evening webinars and raising capital. I had never raised capital before. The first project that we did, they're like, okay, we need 680 grand. It's like, okay, well, you guys try to raise capital. I'll try to raise capital. We'll see what happens. And in 3 weeks, I'd raised 640 and they had raised 40. It was like, oh man, it works. It's validating. The deals are real. It's really working. And from there, like last year, we raised 13 million. And right now I've got a $10 million fund open. We're 4 million into it right now. You just kind of and now that I'm doing it full time, it's like, this is what I'm doing. This is what we do. We're going to protect the assets first, the investors second, and ourselves third. But as you're getting started, there's really nothing that prepares you for that. You just kind of drive after it, and hopefully you've got the support of someone behind you to give you a little bit of grace.
Yeah, and you and I have this in common. Both of our spouses are completely on board with what we're doing with our entrepreneurial activities. And like, I've always thought to myself how blessed I am that my wife is okay with me taking these risks and going after these things that I want to do. And we wouldn't be where we are if she had said, I'm not comfortable with these risks when I was starting off, then I'd probably still be stuck in a W-2 job, you know? And I've got friends who are interested in real estate and they ask me about real estate and they want to get going in real estate. And then we start talking about pulling the trigger on something and they go talk to their spouse and their spouse not okay with it. So that's a big piece of the whole thing. Like, you could be good at all this, but if you're married to someone who's not okay with it, like, that's going to be a barrier for you. So, I know that, okay, you said you've got the entrepreneurial spirit. Like, several things here I want to unpack. First of all, let's talk about the Airbnbs, because I'm an Airbnb guy. People are always asking me, how's the Airbnb stuff doing? I'm curious about how your Airbnb stuff is doing on the beach where you own it. You said it's South Carolina?
North Carolina, Wilmington, North Carolina.
I know you got the management company, and then you've got the Airbnb stuff in Wilmington. And by the way, I went to grad school at North Carolina and lived in Raleigh.
Oh, nice.
So we were in Wilmington. I love that area.
Yeah.
It's really nice.
It's been a great town. Yeah, the thing about short-term rentals and Airbnb is it opens up these different ancillary opportunities. Like, we started a property management company. Now, during the summertime, we'll have 40,000 pounds of linens a month. So then I was trying to buy a laundromat. Instead, we got a warehouse. We created a linen facility. We started doing golf cart rentals for a little bit. And it opens up all these different things. Ultimately, it didn't have the scale I needed to do something significantly bigger if we're going to do some pretty audacious things with our lives. Yeah. So to be honest with you, you asked me how my Airbnbs are doing. I don't exactly know. Gotcha. I have meetings with the company about every other month to talk about hiring and firing and marketing dollars. I will tell you this, within the microcosm of where we live, the first time I ever pulled AirDNA data on a property when I first heard about it through BiggerPockets was there was 1,128 active listings on our island where we live. So I'll never forget that number. It was 1,128 active listings, and that winter it dropped to like 600, right? Nobody's going to the beach anyway, so people take them off. So 1,128 active listings. The next summer there was 1,250. The next summer there was 1,550. The summer after that there was 1,750. And the summer after that, this past summer, there was 2,300. So you had a 650 unit jump in 1 year. And I know why a lot of that happened is because of COVID. There was this massive short-term rental boom, especially at the beach when people had been locked up and so many people working remotely that we never had a slow season for like 2020 when everything shut down for us. And we were shut down April and May of 2020. When it opened back up halfway through May, we caught up on our year by the second week of October, and we ended the year at a 35% all-time high. It's over 88% occupancy on the year, just a few days here and there. And that was 82% that winter, and typical occupancy at the beach in the winter is 19%. So we had a couple years of just massive Airbnb revenue. And so prices started going up. People started buying these properties. And people would buy a property and bring it to us with a completely unrealistic expectation. And so my wife calls me the dream crusher. I'm looking at all these numbers and I'm telling everybody, I'm like, you should not buy this. And if you do, you should manage it yourself. You don't want us managing this. You're not going to bring in 150K gross. It's going to bring in 90, and your net to owner is going to be significantly lower. And they don't know how to break those numbers down. So our market definitely got saturated for the size that it is. Properties that still have done really, really well are ones that have been operating for several years and have at least 100 5-star reviews or more. So my properties tend to do pretty well. At the same time, like I'm in a season of transition. At one point in my life, I thought single family homes were a destination. Then I thought short-term, especially multifamily Airbnb properties were a destination. Owning a property management company was a destination. The reality is, it's a stepping stone onto something else. I would love to tell you at this point that self-storage and syndication is my destination. The reality is, based upon my track record, I know enough to say never, and to not say never on any strategy. But for us, the transition is to something where we can spend a couple months a year traveling and not trade our time for money. But within Airbnb as a whole has done very, very well. Within our island, it did get a little bit saturated, but the good thing is it's an island. They're not making any more land. It can only get so big.
Right.
So I think that's about where it's going to sit. I expect last year was down a little bit. I expected a little bit of a correction, and I think it'll probably level off and go back to traditional baseline rents.
Yeah, that falls in line with what we've been seeing as well. Last year was down just a little bit. Our stuff was down just a little bit. I've seen statistics on other people's saying it was down more, but ours was down maybe like 5% or something. And this year, I feel like it's down a little bit, but it's, all of our stuff's in Gatlinburg, Pigeon Forge. Well, I say all of it, most of it. We've got some stuff on a lake in Alabama as well, but it's still bumping along, profitable, doing well. I do feel like more and more people are buying and it is getting more saturated, but with the rate hikes, that's also, people aren't building as much as they were. And I think, I going into the rate hikes had my phone ringing off the hook with people wanting to buy cabins. As I'm a broker up in that market, and now it's like there's deals and people aren't calling about buying. So the rate hikes have definitely cooled things off, but I think when the rates start coming down, you're going to see that come back in full force. So what are your thoughts? Yeah, the prices will go up at that point. So if you have the stomach for the risk you're taking on right now, and you got the cash, you got the reserves, now's a good time to scoop up a deal and then refinance it when the rates go down. But, being in commercial like you are, and was so rate sensitive as compared to like a 30-year residential loan on a house, what are your thoughts on where rates are and where they're going over the next year?
Well, obviously that's the $1 million question. I just got back from a real estate conference and that dominated what everyone was discussing. The interesting thing with our strategy is that it doesn't really matter that much for us because we're buying the buildings for so cheap and we're doing the construction ourselves. Like we always, when we use banks, we have a fund now. So like we've got 2 properties in the fund. One of them we just paid cash because we've got a fund, we got the cash there. So we can buy a property, just pay cash, and then do the construction and then refi it later, right? Mm-hmm. But when we use bank financing, which we do a lot, we've always been able to get fixed rate debt. We never have variable rate debt. It's typically going to be, previously it would be 75 or 80% LTV. Right now it's 65%. Mm-hmm. We're underwriting at 8.5% interest, but so far, I think our last one was around 7.25. The banks look at this, they're like, well, they're buying it for a fraction of what its appraised value is, plus, the replacement value is significantly higher. And then we're breaking it up into 700 storage units that are very, very safe. We get fixed rate debt. The bank typically gives us good terms. It's a 25-year AM, 5 to 7 year balloon, 65% LTV, and then and fixed rate. We're never doing variable rate debt. A lot of, especially multifamily syndicators, one of the big ones just announced a capital call this morning. A a lot of people have really gotten smashed in that space if you had variable rate debt. And even investors, this is something that I think people need to be aware of. Like we all talk about, you need to be invested in different assets, different geography, different operator. And in my opinion, also diversified across a timeline. If you have different projects that are going to pay out at different times, you want to be diversified across time. But more importantly, I think you need to be diversified across debt structure. And we have people invested with different operators, different assets, different markets. But if they're all using the same variable rate debt, your entire portfolio could be exposed. And when we just had the highest and fastest rate increase in history, a lot of people got wiped out, even though they were spread between a vineyard in Texas, a multifamily apartment complex, and a string of car washes. So it really depends on that debt structure. From our standpoint, we can pay cash. When we use banks, it's always fixed rate, and we're having such a huge value add by the asset class reclassification. Like we don't buy on a cap rate. We're buying a building that's basically worth what we're willing to pay for it because nobody wants 100,000 square feet. And we're converting it to self-storage. So you're changing the formula by which the asset is valued. That creates massive forced appreciation. So even if the rates are high in a year or two from now, and we have a string of properties that we're on the line to refinance, the only thing that's going to change for us is that instead of refinancing to 55% or 60%, we might refinance to 45 or 50%.
Sure.
That's still going to be enough to pay out the investors and not stress the asset.
Yeah. Yeah. The beautiful thing for the investors is they're getting their money back in a tax-free event. They're getting to take the ride with you on the ownership going forward with the cash flow and the depreciation, right? Yep. So, I love that. That's amazing. You're basically doing the BRRRR strategy on commercial.
Absolutely.
Right? Yeah.
That's it.
BRRRR strategy. And it's really better than the BRRRR strategy on residential right now because it's really challenging to do the BRRRR strategy on residential right now. Everything, the prices are so high, the margins have been squeezed on everything, and the interest rates have gone up so much that like on your hard money, by the time you get done paying your points, your hard money, the financing cost of the project, you go to do your refi, you're leaving money locked in. Whereas with this, you're getting it so cheap because of the lack of competition and the lack of demand on buying it on the front end, right? Like you said, nobody wants the 100,000 square foot empty big box or whatever. You go in and get it for pennies on the dollar, get your rehab done, create a ton of value for your investors. You get all your capital back plus some, and then you get to hold the asset long term. That's really where I think a lot of these commercial guys, I've always had kind of a disconnect with their strategy. It's like you're buying it at such a high price with at such a low cap rate that when you go do your refi, you pretty much have to sell it to be able to give your investors the return you're promising. Whereas with your strategy here, you get to keep it. And I've always thought, man, if you could figure this out where you're keeping the asset long term instead of being forced to sell it in a few years, that's where you build the major wealth, right? The value's in keeping it, letting it appreciate and be paid off by the tenants.
You nailed it. So like if you're BRRRRing a house, you're buying a house, you're fixing it up, you're refinancing a house. We're not buying houses. We're buying ugly ducklings that nobody else wants. We're not buying storage. We don't build storage. We buy nasty old buildings and we convert it into storage. When you change that, it completely changes the formula by which it's valued. And you nailed it, right? The traditional syndication strategy is you're going to buy a B or a C class apartment complex. You're going to put granite countertops and you're going to put stainless steel in and you're going to increase the rents. And that's going to push the value up by maybe 30 to 35%, which is not enough to recapitalize by way of refinance. So you're increasing the value 30 to 35%. You're going to hold it 3, 5, or 7 years, and then you liquidate the asset and everybody gets a payday. That's awesome, right? That's great. Everybody just got paid. You know what else? You're basically a glorified house flipper. And the day you stop working is the day you stop getting paid. And the day your investor gets paid back, they have to find something else to go invest that money in, or it's not working for them, right?
Yep.
The idea is like that doesn't break the cycle of trading time for money, right? You're talking about trading the best years of your life to pay for someone else's days off. And if you stop working, you stop being able to buy your groceries. That's stupid. Like, what are we doing? So we don't want to do projects where we have to liquidate the asset to get paid. The way that we do that, massive forced depreciation, our investors get a preferred return in cash flow. You hit it with the depreciation. We do cost seg studies, accelerated depreciation to give a K1 that's going to offset the taxable income. The largest payouts are coming by way of that refinance, return of capital, plus another huge chunk on top, which is non-taxable. So our goal is to try to double everybody's money in 5 years or less, but then we stay in. Everybody keeps their same percentage of equity. We don't cap our investors' return. We never push them out of the deal. We hold it long-term. And at that point, even if we just doubled your money in 5 years or less, cool, that's 20% per year. But what about after that? When you continue to own it and it continues to cash flow with quarterly distributions, that's called an unlimited return. And we still own the property. That's it. Right.
When you get all your capital back, you're playing on house money, right? It's like, I got zero in this and I'm getting a paycheck every month or quarterly or whatever. So
if right now we have a fund, so anyone that invests with us right now, they're getting ownership across 5 different properties across the Southeast. So they're automatically diversified. Well, when we pay our investors out, we're going to try to do the best we can to double their money in 5 years or less. They keep their same percentage of equity in that fund. Now, let's say they invest with us with a second and then a third and then a fourth fund over the next, 10 years or whatever. They're going to keep their percentage of equity in each of that. So even though they're getting a big jump in terms of the short-term returns that they're getting, they keep that percentage of equity. It carries forward. That's passive, truly passive income that is coming to these investors. They can put it into a trust, give it to their kids, do whatever you want to with it. But basically, you're continuing to stack equity that's going to pay out for you and your family. Get away from trading time for money. And if you think about it from a real estate perspective, we're essentially bringing the pension back.
Yeah, I love that. So you've got a pretty aggressive plan to move from 150 million to $1 billion over the next 10 years. How are you going to do that? Is it doing this at a larger scale, the same exact strategy, or are you going to include other asset classes, or what's the strategy there?
We looked hard at doing like build to rent communities and a few other things. The reality is the market and the nationwide REITs that have reached out to us about storage and what they're willing to pay and what they want to acquire really solidified for us, like, this is the way. This is the way. We're in-house construction. This is what we're doing. Deal flow is not a problem right now. There's plenty of these buildings across the Southeast. We're having massive population growth in these second and tertiary markets that are underserved for storage. Even if somebody decides to come in and compete, we bought the Kmart in Danville, Virginia, a mile and a half from the new casino going in. When we were under contract, we found out that U-Haul bought 7 acres directly across the street to put a self-storage facility in. We kept going, and a year later, 12 months, our facility's open. 12 months after that, which is now, it's been 2 years, we're almost 50% occupied. They haven't finished the entitlement to break ground yet. So in terms of speed to market, it takes us an average 12 months from acquisition to opening the door. So like for us, conversion is the way. This is the way that we're doing it. We spent the last year beefing up. We hired a marketing director, new construction supervisors, project managers. It was a year of growth as a building the springboard to launch off of. We went from 100 to 150 million in assets under management. Right now, we've got a $10 million fund that's going to be used to buy $30 million worth of buildings that are going to convert to about $75 to $80 million worth of self-storage. $1 billion sounds like a lot, but when we're buying an individual building for a couple million, we put a couple million into it, and then it's going to appraise for 13 to 17 million. And then you do 5 of those at the same time.
Right.
It starts to be a pretty good clip. And also deal flow gets easier. People know what we buy. Our name's getting out there. It's easier to raise capital. We have people sending us buildings. Our investors are sending us buildings. And typically the towns are very receptive to it because it's a building that's been sitting empty for 8, 10, 12 years. Yeah. They just want somebody to finally do something with it.
Right. Yeah. I love it, man. I think it's great. So, for someone that's got a W-2 job, like, they're probably not seeing some pieces of this story that are super impressive, and they're probably taking some of these things for granted. But I've done what you've done with the leaving the W-2 world and building my business and becoming financially independent from real estate. and it's not as easy as it sounds, right? What's been the scariest part about this whole thing of having that medical device job, sales job where you're making great money and then saying, hey, I've got this big vision for doing this and taking the leap. I know the job ended before you were really wanting it to, but you were already working in this. Like, what's been the hardest part of the whole thing? Is it hiring the employees? Is it taking, expanding your mindset on the scale of the projects you're willing to work on with like millions of dollars on all this stuff? Or what's been the most challenging part?
That is a great question. Yeah, the mindset shift was a lot of it. From a fear standpoint, like I lost my job, and so like that decision got made for me. So it would have been, I don't know how or when I was going to walk away from that. I'm grateful that I did get fired. I had immediate opportunity from two of my competitors. They offered me jobs within 24 hours.
Right.
And they wanted me on board. The doctors were rallying for me. And ultimately, my wife and I decided that this is what we're going to do. And let's put something in perspective here. Like, I don't get a paycheck from Nomad. Like, all of our employees are, they're W-2, and outside of that, they do invest into our deals as well. But I'm a general partner, and that means all the investors get paid first, right? So we've got a valley of several years to get through before things start paying out in a meaningful way, in a big way. But the reality is, my wife and I looked at each other and said, we're going to do whatever it takes. If I have to cash in retirement funds, which I did not do, but if I have to cash in retirement funds, we're going to do it just to keep ourselves afloat, because this is the pathway for a better life for our boys. And if we do this correctly, they're never going to remember that I sold pacemakers. I got a 4-year-old and a 1-year-old, and it's like, this is what we're doing. So it was a decision. Luckily, we had other real estate assets that have helped with that and paid that out, right? So that was obviously, just from a scarcity standpoint, that was the fear method, but it was a decision that we made together. And then outside of that, yeah, man, I think the mindset shift and the economies of scale and getting to the point that you're willing to say the word billion in public, is a little bit intimidating at first. But we're swimming in our saying that we have around the office is whatever it takes. We're going to do whatever it takes to get it done, because we believe in the projects. We believe in the team. It's easy to be confident when you have confidence in what you're doing. So we get validation from our investors. We get validation when we're presenting at conferences and putting our deal out there. And so it's a very, we created this giant, idea, and to step into that and to grow in that idea is a little bit scary, but it's been an amazing ride.
That's awesome. So to drill down a little bit, you were talking about how the investors are getting paid before you, which is normal in this kind of setup. How are you making a living right now? I know you've got the Airbnbs. Are you, after you get the project completed, refied, investor capital back, is the cash flow from the asset now coming to you, or is that how you're making a living? Or
cash flow on the projects are starting to come out. It takes, these are big buildings, so it takes a year to build them out, a year usually to fill them up to the point of being cash flow positive.
Right.
But yeah, we take a 3% acquisition fee. So anytime we close on a building or a project, 3% goes to pay for the office and the salaries in the office. I don't have a salary, but that's just what's keeping the lights on around here and keep everybody rolling. We take a 1% disposition fee. So when we sell or refinance an asset, 1% comes back to the office. Besides that, it's cash flow. The way that we made it work is our Airbnbs, our property management business. My wife is still selling real estate. Not as much. We have a 1-year-old, just turned 1. So throughout that pregnancy and him being a baby, she and I were taking turns staying home while we're both respectively working on our real estate.
Sure.
And then I'm in a little bit of a position right now. We're gonna reposition ourselves. And this is something you mentioned earlier in the high interest rate environment. We all know that when rates go down, prices are going to continue to go up. I've got one property right now. Like the future for us is away from short-term rentals, and as busy as they are, and even though we have a property management company that handles that, if my name is on something, I want to be heavily involved in the operation, because at the end of the day, like that's my integrity and character on the line that can come into question. So the future for us looks like a shift out of probably one of our quadplexes I'm going to sell. I'm actually under contract to sell it off market May 15th. And then I'm probably going to sell one of our duplexes next year because we used to house hack it. We're within the window of having lived there 2 out of the previous 5 years. We can walk away with that at the maximum non-taxable amount as a couple filing jointly. And then, the quadplex that we have, great return on investment. But the reality is the equity has gone up so much that the return on equity is not fantastic, right?
Yeah.
So bought a property, I'll throw some numbers out there. We bought a nasty quadplex for $550 with a net of around $80,000 a year. If we bought 4 individual condos, they would break even. But because it's, 4 units, but 1 set of fixed overhead, we did a full renovation, net of around $80,000 a year off of that. But now it's worth $1.2 million. So I'm still making the same $80,000 off of 1.2. I can reposition that capital and do significantly better than that, even just invest it as an LP into our current deals.
Yeah, absolutely.
So we're going to sell that one and reposition and into our deals. I've taken my retirement accounts, 401k and IRA, and I've converted those to self-directed retirement accounts. I can't invest them into our deals because it's called commingling and it's illegal since I'm a general partner. But I am investing those into other deals, including self-storage and putting those with other operators because I know that money is going to work a lot harder and do a lot better than investing in paper assets.
Yeah. Yeah, I converted all my stuff to self-directed IRAs as well. So
love it.
There's so much flexibility there. And, anyone listening here that's got a 401k and you're trying to figure out how you can get that money into things other than what your 401k is offering, you can convert that to a self-directed IRA or self-directed 401k. Self-directed IRA is another option, but and then you have more authority over where that goes, and you can invest in stuff like Clint's talking about, real estate deals. So, hey, and Clint, by the way, you're the second person I've had on my show that has converted a Kmart. I had AJ Osborne.
Yeah.
Well, I'm sure you know AJ. He's a great guy.
He's great.
But I'm sure y'all crossed paths many times being in some stores.
He's got an unbelievable story. And I think it's the power of the freedom that real estate gives you in life. But we're on opposite sides of the country. We don't have much competition in our market right now. We know it's coming.
Yeah.
This strategy only really makes sense for people that have full vertical integration. You have to have an acquisition team getting the right properties for cheap. You have to raise capital in-house. You have to have in-house construction, and you have to have in-house management. If you're paying retail for every component or some of those components, the juice really isn't worth the squeeze. But for us, it's working really well. We probably have 6 or 8 years before we have serious competition in our area. And that's all we need. So, but AJ's great. And we've been following him. I watch his posts and stuff all the time. The size of their projects is unbelievable. 100,000 square feet is big for us. They're doing right now that's like 300,000 square feet. Unreal.
You'll be there.
Maybe. I hope so.
Yeah, you will. So, and I could talk to you for hours. We probably need to have another podcast episode at some point to dive into your deals because there's so much there. But what would be your advice to somebody that's thinking about getting into real estate because they want financial independence? Most people start in residential. Would you say skip that and go? I know you have a fund people can invest in. There's that, but would you say they should try to do what you're doing, or would it be start in residential, work your way into that? Is it just invest passively? Like, what do you think is the best thing for somebody else to do?
Well, I'm really glad that I started with single family homes and then multifamily because what I'm doing now is the same thing. Like, it's the same lessons: forced depreciation, asset class conversion from a nasty quadplex to 4 Airbnb units. Like, it's literally the same thing. And that's why when my partners told me about what they were working on, it just clicked with me because it's what I've already been doing on a much smaller scale. The only difference is you add a couple more zeros onto the numbers. But besides that, it's literally the same thing. So I'm very much a fan of bootstrapping it and people getting started however they can. The reality is, I think that you need to take a hard look at what your goal is for your life. If whatever you're doing right now in your job has a ceiling, like I had in medical sales, I had a pretty high ceiling. There's still a ceiling. You can calculate that. There's only so many hours in the day that you can trade for money.
Yeah.
So it has a ceiling. If that ceiling is not enough for what you want to accomplish in your life, then the only real risk is not doing something differently, right?
Right.
But what you decide to do should be based upon what your goal is for your life, whether it's time, financial, or independence. That needs to dictate what you set your goal at, and that you should walk backwards from that to figure out what your strategy is and take an inventory of what you have. Like, what do you have right now? You got to have three things. It's time, experience, and money. If you don't have time, you're not going to be able to get experience, right? If you have money, but no time and no experience, you should probably find another operator to invest with. If you have money and you have time, then bootstrap it and go out and get the experience, right?
Yeah.
And if you have time and experience and you don't have money, then find investors to partner and find deals that are good enough that the juice is worth the squeeze when you split it up.
Yep.
Well, I think take an inventory, figure out what the goal is. Don't be scared to have some big, scary, audacious goals, and then look at your inventory of what you have in terms of time, experience, and money, and then solve the riddle for whichever piece you have that's missing, and then pick an asset class and go for it.
Love it. Last question. If you hit your goal, whatever it is, and you have that level of independence, all, with your finances, your time, your commitments, you get to a point where you're like, hey, I can do whatever I want all the time. What are you going to do?
This is the most,
Exactly.
this is the most fun I've ever had. That having been said, I'll tell you this, and construction is going to keep rolling year round, but starting in 2026, we're trying to take a couple months off a year, from May 15th through August 1st, whatever it may be, right, when the kids are out of school. And I want to spend my time, I want to travel a lot. I'm a big fisherman, spearfishing, scuba diving. So like just from a leisure activity, those are the things that I like to do. My wife and I have taken some pretty big boat trips for a couple weeks at a time with our boys in the last year or two. And I'd like to do more of that. My main focus is a fear that I have living at the beach in an area that is up and coming, but a very nice area. I grew up very poor, one of 6 kids. I worry about raising a couple little jerks. I got 2 boys, and I don't want to raise entitled little brats. And so for me, that means learning a gratitude for where we are able to live and what we're able to do by having outside perspective. And we can go to some amazing places, and I would rather die with a stack of pictures of things I did in beautiful places with beautiful people that I love than things. I don't care about things. I care about experiences and the amount of time I get to spend with my kids and the character that hopefully I have and can share with them, because that has the ability to go on for multiple generations after I'm gone and affect people 100 years after I'm dead and people have said my name for the last time, right? So that's much more important. And the way that I think you get that is, number one, time invested, and number two, travel, but travel that gives perspective and empathy, like seeing other people in other places and finding ways to give back in your daily life where you live, but also when you travel other places, because you're going to carry a sense of gratitude, and it comes with a responsibility to try to make sure that these boys see enough of the world to love everybody and to value what they have. That's it. That's my purpose for the rest of their life is that.
Yeah, you're literally saying the exact same thing I say. It's like the interesting thing when we reached financial independence and systematized our business, and like I had the time freedom and all that, was, what are we going to do now? And I wanted to keep doing what I'm doing because I enjoy it. Like if I didn't want to do this, I could be playing golf right now. It's like, but that's not what I want to do. But I'm also fearful of, raising my kids in a bubble and them having nice things their whole life and never having to struggle, right? So when I was 12, my parents moved us to Tanzania, East Africa, and we didn't have a telephone, we didn't have air conditioning, couldn't drink the water coming out of the tap. The closest phone was an hour away, so I couldn't watch baseball anymore. Like all my friends were African kids. I was like the only white kid around. And it's like, I loved it. I had the time of my life, but I also got to see how those people live and how little they have and how happy they are. And so part of what we're wanting to do with our family with this financial independence is take our family and our kids and travel to some of those areas of the world and let them see how everyone else lives and how blessed we are, just kind of like you're saying. So I think that is a huge part of them growing up with a proper perspective on everything and not just thinking that, this is how everybody lives, that everybody has a nice house, goes to a good school, has college, has a nice car, has all this stuff. That's not how most people live, So there's a level of gratitude and just being thankful about what you've been given and having perspective on it that's necessary, I think. So I'm with you, man. We got to make sure these kids grow up right and are raised right. So
totally agree. That's awesome, man.
Yeah. All right. So tell us how people can connect with you.
Yeah, the best way, I talk to investors all day, every day, and I love it. I'm happy to talk to anybody about anything, answer any questions. You can reach out to me directly, Clint at nomadcapital.us, or you can go to our website, nomadcapital.us, and we've got some videos on there about what we do, how we do it, the people involved, and things like that. But always happy to connect with anybody who has interest.
Awesome. Clint, thanks so much, man. This has been a great episode. Really appreciate your time and stuff, and look forward to hanging out in person sometime soon. Definitely let me know if you're down this way.
Hey, shameless plug. I'm very looking forward to getting you onto the Truly Passive Income podcast.
Yes.
So any listeners here, feel free to jump over there and hopefully catch that episode in the next few weeks.
Absolutely. Yeah. You guys go check out Clint's podcast as well. And Clint, I'll definitely be looking forward to having you back on this show as well at some point in the future.
That sounds great, man. Thank you.
All right, man. Thanks. We'll catch you next time.